Everybody. Well, we appreciate you guys taking the time to be here today. Very excited about today's event, and yeah, thanks, Maverick. We appreciate you being here. Looks like we've got a great crowd tuned in. You see on the timer we've got about 40 seconds. We do our best to kind of stay on schedule. We value your time. While all our events are free, we know that time is valuable, and so we appreciate that from you. And again, guys, our goal here today is to help teach you about the markets. We've got some great guys lined up. You're about to hear from Jim Cagnina of Infinity Futures, who is just an all-around good guy, and going to share with you some good information. So we appreciate you taking the time to be here. I'm excited. It's going to be a good day. We do record each session. We'll post a copy of the session on our site and email you guys for everyone. So at this time, I will turn things over to Jim.
Morgan, thank you so much for that introduction, for inviting me. I was very excited to be invited here. I think this is the kickoff event, which is exciting. We're here early in the morning because we like to look at what goes on in the morning before we start our busy day. So thanks again for doing that. I'm a little bit horrified, though, because I was going to talk about market profile today, TPO, charts, volume by price, and I looked at the schedule and I see Greg Weissman right after me. And this is kind of some of the principles that he applies, and he's incredibly knowledgeable and very good. So I'll try to warm him up a little bit for us, because when Greg pops on, you guys are going to enjoy it. He's a good guy also. So my name is Jim Cagnina. I'm with Infinity Futures. Before we get started here, I just want to share a couple of links with you. My email address is trade@infinityfutures.com. It's easy to remember. It actually goes to me. I'm a manager here at Infinity. Website is infinityfutures.com. Feel free to go there and browse around. And we also have a new website called myemini.com, which is video-driven, video-centric website that provides daily market videos on the E-mini S&P. So feel free to check that out. It's a work in progress. We just launched it about a month ago, but it's pretty cool. It's a free membership site. Let's talk about risk a little bit. Trading futures and options on futures involves substantial risk of loss, not suitable for all investors. In futures trading, you oftentimes have a high combination of leverage and volatility. And although that could be an equation for opportunity, it's also an equation for risk. So be careful. Only fund your futures trading account with risk capital. My personal definition of risk capital: money I can afford to lose, doesn't change my lifestyle, doesn't lengthen my retirement horizon, or doesn't overly anger Mrs. Cagnina. Now, I understand everybody is unique and different on risk capital. So if you're not sure where you fit on that curve, give us a call, give me a holler. I'd be happy to talk to you about it and give you my opinion. I've been doing this since 2001 here at Infinity, so I've been around a while, and I've seen a lot of stuff. Okay, I just hit the general chat thing. Secondly, past performance not indicative of future results. No matter what I tell you about a successful trade yesterday, keep that in mind going forward. The paradigm of the market could change given the same set of circumstances from a charting point of view. Okay? Any questions, just type them in. I could pick them up as I go here. I'm just getting used to this screen here. 1 second. Let's see if I can get some chart. Let's get right into it. All right, we're going to talk about market profile. This is a concept. It's kind of a weird concept. It's different than other charting concepts because the x-axis here, this x-axis here isn't time-based. It's not a 15-minute time frame, 30-minute time frame, 60-minute time frame. This axis is not time framed. It's based on where trades occur at any given point of time. So the way it works basically will kind of lead up to how I would use it. I know there's a lot of stuff on this chart, and I drew it last night, but I'm going to go through it a little bit at a time here, and hopefully you can see my little arrow here. I'm going to use that to highlight stuff here. The concept is this. Every 30 minutes, we assign a time frame, a letter. Okay, so let's take a look at what that is. Let's see. 30 minutes is a convention, right? This isn't something that is set in stone, but most people use 30 minutes. So 30 minutes. And let's say we start our market profile chart. You can start it whenever you want, but I like to start it at midnight. And I'll tell you why I like to start it at midnight later. But so let's just say from 12 midnight to 12:30, we're going to assign a capital A to that time frame. Okay? And then at 12:30 to 1, we're going to assign a B. 130, I'm sorry, oops, 130 to 1 to 130, we're going to assign a C. And this will continue every half an hour, right? So at 12 o'clock, you see this little A here, this letter. Let me get a crosshairs out here if I could do that. Not Jim, I got that other line. This A right here, at 12 o'clock, the market traded at 1833.37. And then for that first half an hour A period, right, the A period, let me bring that back up. The A period goes for half an hour. Every price that prints during that A period, you get another letter. So we had 1, 2, 3 letters down. We had 1, 2, 3 letters up. So that takes care of, that's the range, right, for 12 to 12:30. Now at 12:30 to 1, we start writing down B's. Okay, so there's a B here, and it printed this price here as a B, and you can see if there's already an A in a column and it prints the same price 30 minutes later, you move the B out in front of it. So you're creating this distribution, this Gaussian curve, this normal distribution here. Okay, and then we make new prices, we make new highs, and the B's keep printing. Okay, and so then at 1 o'clock in the morning, we're going to start printing C's. And then as you can see down here, at 1834.50, we went down and printed that number. So now the C is behind the B, which is behind an A. Is everybody with me so far? We used to do this. They say Stottlemyre invented market profile, I don't know, in the early 80s. And I was on the floor of the board trade about then, maybe a little earlier in the U.S. Treasury bond pit. Back in the day, and this is before we had all these great online tools, this great online software. This is the Infinity AT Charts, which does all this stuff automatically. But we'd sit at the edge of the pit, and we would write, because I was a clerk back then, right? I was like 12 years old in 1979. No, I'm just kidding. Just seeing if you're paying attention. We'd write on a piece of paper, and we'd draw these, and we'd run them into the broker or to the local, which we called people who were trading their own account in the pit, and we would show it to them, and every half hour we'd come in and out, and we'd sit at the edge. This is what we do. So this has been around a long time, this concept, by the way. So the computer, though, generates all these letters automatically. We don't have to worry about doing them on a piece of paper, right? Now, I start at 12 o'clock in the morning, 12 o'clock midnight, Chicago time, because I consider it the pre-open in Europe, right? Europe opens up at 2 o'clock, give or take, depending on daylight savings and all that stuff in Chicago. So I like to capture the pre-European open, see what happens all night, and then see what happens in the morning, okay? And there's a way to split the charts in half. I'll teach you that in a little while. Time, this profile, market profile, develops. It takes time to develop. You could apply this on a daily or a weekly. I'm showing you right now a daily. We'll look at a weekly in a second. Now, you see a couple color schemes here. You see this red lettering that goes all the way across. And if you notice the red lettering that goes all the way across, that's the longest, I guess you can call it bar or line that there is. That's called the point of control. And the point of control is the place where the price traded the most times during the cycle of your profile. So the point of control here is 1837. That's not to be confused with the most volume that was traded at any given price during the day. It only says how often, how many 30-minute segments, the most 30-minute segments that the market traded at a given price. That's the point of control. Okay? Casimir asked, would I start DAX at 2 a.m.? I would go 2 hours before, Casimir. I would take the DAX. I know it starts at about, I'm going by Chicago time right now. I would start it at 12. I would get that 2 hours of pre-market. You're going to get 4 letters, right? You'll get A, B, C, and D before 2 o'clock. And so you'll have some information that you're going to be able to use. Okay, so That's what we're going to refer to the red line here. Sorry I deviate, but I like to do that. So feel free to pop in and ask questions as we go. Now, you'll see a couple other color schemes here. You see green letters, and then you see blue letters. The green area is referred to as the value area, and that basically equals one standard deviation of trades, of these letters, of when a price trade occurs. This is one standard deviation worth of letters. It's actually not. One standard deviation is 68%. This is 70%. Okay, we have it defaulted at 70% of the action here is in green. It's called the value area. Now, prices above the blue stuff up here, the blue letters up here, that's prices. It's called prices above value. This is just the nomenclature that we talk about. Prices above value are these blue letters up here. Below here is prices below value. Okay, and what we've observed over many months and many years is that oftentimes a market trades with what's called a bell-shaped curve. This is pretty close to a bell-shaped curve. I mean, it's not perfect. It's never perfect, but it looks pretty good, right? And it's a normal distribution, a Gaussian distribution. Sometimes it doesn't look this way. And my guess is when we look at today, we'll fast forward to today's market profile, it's going to look a lot different. Okay, but this is called a single distribution, normal distribution. Okay, and so now the idea here, depending on where the market is, this value area can create areas of support and resistance. Okay, so if we're trading below in the value area or lower, then this top of the value area becomes support. If we're trading at prices below value, then the bottom of the transition line here is considered support. Hopefully you can see those green lines. The opposite is true on resistance. If we're trading above prices above value, then this becomes resistance. Now this is just another technique that you're going to add, right, to all your other stuff to determine where you're going to put your stop, where you're going to enter, and all that stuff. So this is just giving you a little bit more information on the market and giving you a little bit better idea of where you want to get in and get out. It's not an absolute truth that if we're trading above value, we're not going to break on down through the value area completely, right? We've had markets fall out of bed. We've had markets break out on up. But it gives us kind of an idea. And depending on the circumstances of that day, what news events are there, what unexpected activity is in front of us that day, we could kind of use that forward information to decide what's the likelihood of having a continued normal distribution for today. Is there anything out of whack that's going to cause the paradigm of price to move, to break on out to 1842 or to break on down to 1832? So as the day goes on, the profile becomes more and more important to me because prices do tend to gravitate. Equilibrium. Someone mentioned equilibrium in here. Yeah, I mean, the idea is this is equilibrium. This is where buyers and sellers are most happy. This is where buyers and sellers, 1837, are most happy. That's most times during that day that a buyer and a seller agreed to a price. So it creates kind of a gravity effect. Not always, but a lot of times. Okay. Bill said he's not getting it. Okay, so it's a really easy concept. It's really hard to explain. It's really hard to teach. You got it, and we'll fast forward to today, so maybe it'll be in a little while, and maybe it'll be easier to understand when you see these letters. Remember, we're just looking at the 17th, February 17th data. Forget about this stuff over here. Forget about 12/18. That's the next day. And then forget about this shadow here. That's the next day. Okay, thanks, Jeff. Now, there's this little histogram on the right. What is that? Well, I put it side by side. This is called volume by price. This just puts a bar. It counts how much volume occurs throughout the day at any given price. And oftentimes, the volume by price is very similar in its formation than the market profile. And Greg Weitzman's going to go into real detail on this. He's very awesome on this. But so it seems similar. However, it's not exactly the same. You can see here our point of control is 1837 on the market profile. If you go up here, you see this red line here. The point of control for the volume by price is 1838. It's a little higher. Okay, and all that's saying is there's 11,408. The volume was 11,408 contracts traded on that day at that price, and it's the point of control because that's the longest line. And if you can see these little gray lines up here, 1839 half, 1836.75, those are just kind of mimicking the value area, the one standard deviation, when the price occurred. And that's why on a daily chart I like to look at the letters, because when the distribution gets skewed, I want to know what happened A, B, C, and D. And maybe that was just night stuff pre-Europe that's not going to really matter anymore during the day. And again, we'll look at some more distribution types. We're looking at the E-mini S&P March 2014 contract. Now, okay, Michael has a good question, and this is the heart. This is where most people where it's confusing. Okay, let me ask the question. Does this mean that the more that a particular alphabet appears, that price will repeat itself? Well, don't forget, every half an hour, you never place. When this market opened here, 1837.75, we opened up, we put an A. We never put another A behind it. There's never two letters back to back. We're done. If we trade up here to 1834.25 and then come back down, we don't print an A again. We already printed an A there. It's already filled for that half an hour. Now the question is, let me just repeat it. Does that mean the more the particular alphabet appears, that price will repeat itself? Well, yes and no, not necessarily. The way I would like to use this is to look for actual market prices that are away from the point of control, but within the distribution. Then we can make decisions on where to put stops and where to put entries. So, for instance, here's the point of control at 1837. And let's say where it's 10 o'clock, later on in the day, and the market's trading up here, I don't know, 1838.50. Forget about any other thing that's going on in the marketplace right now. Fed's not going to say anything. There's not going to be any crazy new announcement. It's a regular day. Economic releases have been issued. The idea here is that we're going to settle down closer. By the end of the day, we're going to get to the 37 area. At least we have a higher probability, right, to get to the mean. And if I go short up here, then my stop is going to be either, if I'm super conservative, right here at the transition between prices above value and value, or up here at the high of the day. So that's how personally I would use it. And we'll look at some trade ideas as we go forward. Right, Sean. I think that's right. All right, I'm so not used to this TradingPub thing with the questions over here. That's right. I'll get it. All right, so that's kind of that's the basic concept. This is the basic idea here. Okay, thank you, JT. Now let's take a look at a weekly. Now this is a daily, right? So every 30 minutes it's going to put a letter down. Now I have it formatted a little differently for a weekly. Let me erase this because I did this yesterday. Now instead of letters, by the way, one thing I forgot to tell you. These letters go all the way. You'll see little letters in here. It's like, wait a second, why is there little letters, big letters? Well, you go through the alphabet, A, B, C, D, E, and when you get through 24 of the letters, you're not going to see a Z on a TPO chart, on a chart. When you get through 24 of the letters, it starts over again with little a. So there's no YZ. So you get to X, big X, then the next half-hour period is little a. And the reason is there's 24 hours in a day, right? So it's a half an hour, 48 increments. That's why they do it that way. Now, I've changed my market profile look here. I've taken the letters away and I've created blocks, TPOs, time price opportunity they're called. Excuse me for this cold, I'm sniffling, I feel bad, but here, for you guys, not for me. So what I've done on a weekly, because there's so many A's and B's and C's and D's over the course of a week, it gets confusing. So what we've done is we've taken these letters and created blocks. And again, the point of control is still red. It's right here, 1835. The value area is still green. Prices above value is blue. Prices below value is blue. Okay, so this gives you a weekly peek of what's going on here. Let me try to shrink this up a little bit. This is this week, 2/16. So we started Sunday night. We started Sunday night. And we stayed, as of yesterday, up till yesterday, we were in this nice range here. This morning we broke down here, and we're starting to develop another, I don't know, what do you want to call this? Mountain, bump, distribution. And if it continues like this, then it would be called a double distribution. In other words, we have a second distribution level. Okay? So from the weekly trader point of view, this gives you yet another area where you consider maybe stops down here, targets up here, or vice versa. You know, stops up here with the expectation of a breakout. And if you really want to get fancy, you could put two together. This is last week, this is this week. And you could make the observation, the point of control last week was 18, 15, 25. Is that an important number to you? I don't know. It might be. A lot of buyers and sellers liked it last week. Maybe they'll like it this week. Maybe that's a good target. Maybe that's attraction. That's a magnet. I don't know. But those are the kind of things you could probably go drive yourself crazy thinking about because there's so many combinations. But that's some of the approaches that we like to use. This was a popular price last week. It's not there yet, but I don't know. It's Thursday. We're getting there. Okay. Let's go back to a daily here. And I want to show you another thing. What some folks like to do, they like to take a daily distribution and they like to separate it. By separating it, I'm going to go to the P, capital P. That starts 7:30 Chicago time. That's 7:30 to 8 Chicago time, right? That's what P is. And a lot of people, including me, think, you know, that's really when the U.S. market opens, right? It's not 8:30 when New York opens. So, you know, stock exchange, yeah, we get a lot of volume and stuff, but at 7:30, you know, bonds are coming out. Everyone's out of bed. Everyone's ready to go. And so at 7:30, I like to consider that. I don't even consider that the pre-open. I consider that the open. So you could bifurcate this. I'm going to right-click, and I'm going to go split profile here. And now it's separated them. It's moved them in. Now forget about all these pictures that I drew because that's kind of mucking it up now. But I separated it. Here is early morning, and here is after the open. So you can see, all right, here's what happened morning. In the U.S. where we woke up, here's what happened. So now if I wanted to draw my lines again, let's go ahead and erase this. Where's my erase? Okay. If I wanted to erase this, I can. And I'm going to get my rectangle back here. You know, I'll draw it here. Here's the day action. Things look a little different, a little bit lower, not much lower. Or actually, it might have been the exact same, come to think of it. It is the exact same. But it tells us a little bit of a different story, especially when you have volume way up here. And from a day trader point of view, now we have a range in which we could play in. We've defined our conversation. We've made a discrete definition of where we want to get short from, where we want to get long from. Now, in this particular day, it was a low range day, probably a low volume day. I don't remember. So it was really a tough day. You know, you can get a couple of ticks here and there, but you know, I don't know. I don't subscribe to that method, but some people do. Lori asks, does it appear as though you could only calculate standard deviation at the end of a day or a week? Or is it progressive? It's progressive. It's like a moving average. Let me show you. Let's go to today. Sorry, I jumped ahead here a little bit. That's okay. How do I erase this stuff here? Erase, move drawing, adjust, erase. Let's go to today. Let's get the range back up here. Today's not completed, right? Today's not completed. Here's the 20th. Get that so everybody can see it. And it's right in here, right? So it's calculating this on the fly. So when things shift, they'll shift up or down based on the standard deviation, based on the settings. Now you can set the value area to whatever you want. If you wanted to set it to 80%, to 60%, you could do that. The default's just 70. Okay, but that's a good question. Yeah, this is like a moving average where you take the last certain amount of data, calculate the moving average, and then the next time frame goes on, you recalculate it and you plot it again in a continuous line. That's kind of what's happening here also. These are Infinity AT charts. Yeah, that's what we use. That's integrated with our trading platform. So I'll show you guys that later as we go here. All right, so what do you guys want? What else do we want to talk about? We have the volume. We have that. We have we're in the O period right now, right? And remember, in 3 minutes, let's watch this together. Let's watch this together because in 3 minutes, this O is we're going to start printing P's, right? We're going to start printing P's. Now, if the price trades 1925, we won't print another O. 1975 won't print another O. Won't print another O all the way up to here. Only if we get down to 1819 in the next 3 minutes, or whatever the time frame is, 5 minutes, 3 minutes, will we get another O. After that, we're going to start printing P's. Chris is ready to go with some trade ideas. So look at today's chart and tell us what trade you'd suggest. All right, we could do that. The way I like to kind of look at trades is this. I'll start with a weekly. Let's go ahead and we'll fast forward to the punchline. Weekly chart. What's my bias? Okay, what's my bias? My bias is bullish. Why is my bias bullish? Well, look at the chart. There's no technical analysis skill whatsoever for me to tell you this. The one thing that I am going to notice here is we've consolidated now. 1807, 1846.50. We've been range bound here for a while. Yeah, we had a little breakout. Well, maybe not a little breakout, but a big breakout, and we shot back in this range here. Okay, so that's one thing I'm going to notice, that the bull market seems to have taken a hiatus. Daily. Now we go through this in our Let's Talk Futures thing, so I'm not going to recreate exactly how I got this chart, but basically what you're looking at is a daily candle chart. In the middle is volume, and at the bottom is synthetic VIX. It's kind of it's an estimate of, where'd it go? I lost my synthetic VIX because I messed it up. This blue line here is synthetic VIX, and it's a volatility measure, right? And around the synthetic VIX, I got a Bollinger Band. That's the green. So that's kind of the things I look at on a chart. And the idea is that when the synthetic VIX is low, we're typically at market tops. When the synthetic VIX is high, we're typically at market bottoms. This is a Larry Williams concept. I don't know if this is true or not. But oftentimes you see the behavior identical to how he predicted it would be. Not saying he's any better than you or me, but anyway, so I've defined this bull area, right? This is above 1812.50 in the December contract. We noticed that we've created that support and resistance way back in December. So that's kind of my Jim Cagnina magic line. I like the 1807 number. And then a neutral area here is developed, in my opinion. It's like I don't have an opinion. I don't know what's going on. And then a bear area here. Now, we entered the bear area for a little while, but we didn't sustain it. And we had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 green handles in a row. And then we have 1, 2 red candles right after that. So this confirms my bullish bias. However, these two bars have me a little worried now. Now, on top of that, the commitment to trader reports that were published last Friday are suggesting that the speculators are moving their long positions to the short side. Okay, it's delayed data, and oftentimes it flip-flops back and forth, but we had about a 70,000 contract move. So I'm a little bit worried. I'm even more worried now. So my bullish tendencies are a little, I'm still bullish, but I'm cautiously bullish. And these two red bars are telling me, hey, maybe we are going to have a little bit of a retracement today. I woke up this morning, I didn't listen to any news, I haven't seen any economic indicators, anything like that. I'm basing this on the charts, okay? What happened last night's the next thing I look at. All right, what happened in Europe? Well, nothing. I mean, sideways, right here. By the way, this is a volume by price behind here in the orange. I change the colors up sometime. I'm an older guy. I can't see so good sometimes, so I change the colors the best I can. Hopefully you can see it. But, you know, and at 2 o'clock, nothing really happened. Yeah, a little bit of an upsurge. I mean, what is that? Three handles, nothing to write home about, 150 bucks. We settled right back down to where we are. Okay, so there's no clues there for me. I have no clues here what I'm supposed to do. Let's take a look at, before we go to the daily and say, okay, what's my trade idea? Let's take a look at the weekly. The weekly, make it a little bit easier to see. The weekly is bringing the distribution back down to last week as of right now. Traded up here earlier in the week. The range was pretty small, as you remember, earlier in the week, and now we're back down in here. So commitment to traders, two red bars, long-term bullish, but right now I'm not quite so bullish. So what I'm looking to do, what I would be looking to do is, and I'm a limit order kind of guy, right? So let me draw some lines here to make it a little bit more understandable what I'm about to do. Let me make this, we're going to make this a red because we're going to stop here or higher. And then let's make a line, this line, a green color. Well, let's make it a better green. Let's make it a better green. Let me move it down a little bit. How do I move this thing? There we go. Move it down into here. Now, there's another concept about market rejection I haven't talked to you about yet because I just don't see it strongly printed on the chart. I'll go back and try to find an example of market rejection. But in my world, and this is a conservative trade idea. Let me get a trading ladder up here to make it easier to see. I want price. I want to go short. I want to see if this distribution continues to form, this double distribution down lower here. I don't think we'll get past 1807 today, but I could be wrong. Remember, that's an important number for me. But there's still a lot of downside between 22 and 07, or 26 and 07. And if we shoot back up into the value area here, this is a weekly, I'm worried I want to get out. So this is just a demo account. This is just I'm just going to show you how you put this trade in. I mean, you would just simply put a limit order here. Okay, reminds me I'm on a simulator. And then I'm going to put my stop up probably at 32.25. Okay, so the idea here is let's be patient. Okay, this is a conservative trade idea. You might not get filled, but remember the second best thing that could happen to you is you don't get filled, right? The first thing is you get filled, and it's a successful trade. The second thing is you don't get filled, and you live to fight another day. And the third thing is you get filled, and you get stopped out, and you lost money, right? So it's okay to be patient. And this setup is kind of conservative, right? We got to go up almost four handles, 3.5 handles before we get filled, but it's not even, it's 7:35. We have a lot of time to wait. And how much are we risking? Well, we're risking $312, and you know, it's a lot per contract. But our target, hopefully, is going to be closer to lows, right? Lows of the day. So we're looking to make more. We're looking to get down toward the low of the day because as the distribution builds, we want to envision a curve here. This is a weekly, so it's going to take a while. So that's like that's trade idea number one. If you do it from here, let's get my if you do it from a daily, you're more aggressive. If you're doing it from a daily, you're more aggressive because the average range is less. The range is smaller. We're literally trying to sell the tops, which is going to be hard to do. But I prefer the weekly point of view. I prefer the patience. I prefer, even though I make more money when you guys are running out in and out, sometimes you don't. And I don't want to encourage that. I'd rather have you do better. All right. So I don't know who asked that question about. Give me the trade of the day, but but that's it. Let me try to find a distribution. I want to try to find. Okay, here we go. Let's take a look at the 19th. This is it's going to be kind of hard to fit it in the screen, but let me try to make this a little bit bigger here. And let's see if we could. I don't want to clutter it up too much. All right, so this is the 19th, right? So yesterday, point of control way up here at 1835, right? And this doesn't look remotely like it's a bell-shaped curve. I mean, look at this. It goes down and down and down. Well, there's other distribution that has occurred throughout the day to create multiple distributions. And a concept of market profile that I think is kind of important. Let me get a rectangle here. We'll do a rectangle. Is these areas of market rejection. Now, Dan Graham's taught me this. This is a Dan Graham's concept. This is a concept, this where there's only one letter printed, and you have this big distribution above, big distribution below, a couple other, one letter printed, or even two letters printed, big distribution below. These are called market rejection areas. The buyers and sellers aren't interested really in staying here for any length of time. They're not interested in this price level, excuse me, for whatever reason. So how do you use that? How do you use the concept of market rejection? Well, depending on your position or your entry idea, I would like to consider using it as areas where the market is going to fail, which means my limit order's below it or my stop's below it, depending on if I'm long or short. Those areas I think are kind of important, especially when they repeat day to day, or especially when they're significant in a weekly chart. It's kind of a simple idea. The market's not interested in trading here. I mean, look how many letters are up here. Let's get the crosshairs on. Right there. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 half-hour segments we printed right there. 5.5 hours. Here it was some amount of trades, maybe, within 1/2 hour period of time. All right. So, I mean, this is the best example I could find. We could go, yeah, I hear you, Jeff. No, not Jeff. Yeah, this is just an example. I just wanted, it's, we can go back and keep looking at different profile distributions as we go and drive ourselves crazy and see different patterns. Cookie, I'm not sure that's a Trader's Pub question. Let me go cruise up here. I missed probably 800 questions. Tricia asks, disadvantage to Bollinger Bands and volume. Yeah, volume seems to be the same concept viewed differently. Let's talk about volume first. Volume is, and I want to go back to the day that I had it up here. Well, we could take, we'll use today. Bear with me while I get this thing straightened out here. volume, and I, you know, what Greg Weitzman taught me, by the way, who's up next, the terrific fella, is volume is kind of the poor man's market profile. And it is because usually in these charting software packages, you know, you get volume by price for free, but you got to pay for a higher subscription for the market profile. So somebody agreed with me that Greg Whitesman's a great guy. Which he is. And he's going to do a better job of explaining this than I am. But you can see that the profile is similar. You can see that the point of control is not too far off. You can see that the value area is pretty similar. And oftentimes the volume is very highly correlated to the amount of time it trades in any given time period, in a total time period, rather, of the day. I mean, it makes sense. The more half-hour segments that the market trades at a price, the more volume there's going to be, usually. Not always. Anyway, he'll be. I'm gonna rely on him to do a better job of explaining that to me. I think I'm not sure who asked that question. All right, let me scroll back up here. Okay, Wayne, that's pretty good. Let's go scroll back up here. I think I got them all. I think I covered everything on here. Stuart, yeah, I think we answered your question, Stuart. If not, type it in again. But yeah, so he says to simplify it for me doesn't mean that every time a price moves within a specific time frame, either up or down, another letter, A or B, appears. Yes, that is absolutely true. And by the way, now that we missed it because I was talking, we're printing P's. Remember, we were printing O's. We're looking for P's, and we've printed them, you know, all the way back up. And the reason is because the market knows I want to get short here. I'm just kidding. That's not the reason. That'd be nice if it was the reason. As long as it doesn't keep going. So, all right. What else do you guys want to talk about? That's you understand the blocks, right? The blocks are just all the instead of all the letters, we just made them blocks. That's all. We just colored them in. We just colored this thing in. Yeah. Do that a little bit better. All right, so let's get a little bit more sophisticated. Just a tad bit more. I'm not able to get really a lot more sophisticated, but we'll get a little more sophisticated. You could see each TPO letter represents one tick. So every time a new price prints, you know, one tick in the E-mini S&P, everybody knows, is $12.50. It's traded in quarters. Each point's worth $50. We all know this. And so that's how I form this thing. Now, alternatively, you could do it a little bit differently. You could say, hey, I only want a new TPO block every 4 ticks. So instead of every tick printing a new letter, I want the TPO block to only print every 4. Okay, what does that mean? So let's go ahead and say, so from 18, 20, 25 to 18, 21, 25, I only want to print one letter there. 18, 22, 25. If the price moves up to 18, 22, 25, then I want to print the same letter because we'll be in the same 30-minute time frame again. 18, 23, 25. This would result in two letters, not 8. Now, that idea works a little bit better in markets like the Euro FX, you know, where you have a big daily range and the TPO is kind of off the chart. the thinner markets that kind of behave more like you have the popcorn effect, right? You hit, it's the volatility is extreme, tick for tick. Gold, crude oil, these kind of markets sometimes could be like that. And so you could adjust your the size, basically I'll call it the size, the price range for your TPO letter accordingly. Is everybody with me? And on these, how do you do them on these charts? No, I don't want to do that. How do you do them on these charts? Good question. You go here, and if you're using Sierra or Infinity AT charts, letter block price, it's right at the top. Letter block price increment and ticks. I have it at 1. I could change it to whatever I want, really. 2 ticks, 4 ticks. Bonds is kind of hard, right? Bonds are tricky. Well, the average daily range has been a little light in bonds, but bonds is kind of tricky because it's traded in 30 seconds. So what's divisible? What goes into 32? Well, 4, I think. I don't know. My kid's he's in 5th grade, so I'm learning math over again. We got 4, 8, 16, those kind of increments. You can go 1 also. You can go 1. And it's easier to go smaller increments when you're in here, when you have a lot of data to look at, a weekly chart, for instance. Or you could do a monthly. Jim Hyercheck will say, hey, let's start with the yearly, go to a month, monthly, weekly, maybe daily. I mean, there's that kind of extreme look at price. But depending on the time frame of your trade, who knows? So that's another thing you could change here on market profile. I want to go back. And all right, so the P session's going on right now, and let's go ahead and bifurcate it because P is 7:30. Remember, I think 7:30 is important. So we're going to split the profile here. This is just kind of for fun. We're doing this part for fun. Here's early morning. Here's midnight till 7:30 on this side, and on this side, we've got 7:30 going forward. It's a popular practice to do this. Obviously, it becomes more information rich as we accumulate time going forward. So by 9:30 today, we're going to have several more letters that are following this. Okay. All right. Any questions? Let me scroll down here. Oh boy, there's more down here. All right, so remember, Sylvia, when you're trading futures, you got to look at. It's a good question. You got to look at the market you're going to trade. You got to look at what your you got to look at what your method's going to be, and you got to choose an account size that's reasonable. And the account size needs to be reasonable so that it matches your strategy and you have a chance to do well. Most people, have a hard lose money trading futures. It's very hard. We talked about risk earlier on today. So it's important to know that risk capital only. Sandra asks, do you consider news in your decisions? You got to be aware of the news because the news does have an impact. The news does have an impact on what happens, and I think this chart speaks for itself. I mean, we have a raging bull market. This is, in my opinion, this is a Fed-driven QE1, QE2, Operation Twist, QE3 driven bull market. And you could even see the little pullbacks prior to the, related to Fed uncertainty in the chart. So that's kind of one thing. And then you look at, okay, so why does the Fed do what it does? And it's like, well, what are their measures? Unemployment, housing? What are the things they're looking at to measure what their behavior is going to be in the future? How fast tapering is going to occur? Is it not going to occur? Or are we going to stop it? So, housing numbers, unemployment numbers. By the way, it's called the employment situation now. When I was younger, I don't want to point any fingers, but it was called the unemployment number. Now you go to Bloomberg, and it's called the employment situation. Someone decided to make it sound better, but those are the those kind of numbers impact not only immediate price action from a day trade point of view, but also longer term price behavior, because then what's the Fed going to do? So yeah, they're important. And there's two kinds of traders. I mean, I've been in Infinity since 2001, and we've seen. We started out with online trading platforms. JTrader was the first one that we used, and I've seen everything. We've seen every type of trader there is. There's the news trader. We even have breakout brackets on our trading platform, so you could have a breakout bracket, automated OCO breakout bracket on the trading ladder to trade news if you want. Would I do it? No, I'm not good enough. I'm too scared. My risk profile is too extreme, too weak to want to do it. But you could do it. So it just depends again on your style. In hopes the money is allocated to Main Street, but instead it all goes to risk assets. Well, yeah, I mean, whether or not the idea that the price of this market is fake, in other words, it's not related to the economic situation of the country, is irrelevant to me as a trader. One thing is relevant to me is where I want to buy and where I want to sell. Where's the opportunity? It doesn't matter how embedded in reality it is to me. I want to look at the candle. I want to look at the market profile, and I want to see where buyers and sellers are coming in. I want to see where prices are popular, and then anyway, all right. If I miss something, Jen said this. Don't worry, we're going to get to the good stuff in a second. Hang tight. If I missed anything, let me know. I'd be happy to fill it in. I just want to show you a couple of websites really quickly. I won't kill you with any promotional stuff. This is us, infinityfutures.com. The charts and the trading ladder that I showed you, you could try them out yourself right here for free for 30 days. The exchanges allow us free 30 days of real-time data. Thank you, Morgan, for putting that into the screen. So feel free to go there. We've got a whole bunch of them. I'm always talking. People are tired of me, but if you want to hear more of me, come to this page. You'll see some stuff maybe that might be interesting to you. And then, as I discussed, myemini.com, brand new website. These are kind of all 101 videos on the main page, but once you register, you're going to get. Let me show you. Let me show you what you get. Membership site is free. Ray Burchett, he does daily trading videos, and these are trade ideas. He usually does his at night. Adam Beeler, directiontrader.com, he does a midday recap every day. And you just click on the button over here and it plays. It's a great thing to do if you're taking the train to work, works on your mobile. And then that's me about 15 years ago. And I usually do mine in the morning. I didn't do a morning one today because I'm with you guys. I'll do one a little bit later. So there's a couple. That's a free resource. As you go through the discovery process of whether futures trading is right for you, get as many of those free resources, many of these webinars as you can. Morgan's doing a great job with TradingPub in providing all these different points of view. Everybody has a different point of view. Greg might have a different one than me. Ray Burchett, who we just talked about. By the way, Ray Burchett on My E-mini, he is a 20-year pit veteran. 20 years in the big S&P pit is hard. Just physically, it's hard, let alone to make a living doing it. So he's an interesting character. He's got a lot of good insights. Sandra says Ray is awesome. Thank you. And Shauna, don't leave. Forget about work. Call in sick. We think Patrick's the best. Thank you, P.O. Appreciate that. He's my associate here at Infinity. He's very talented. You are absolutely correct. 7:55. Jonathan says, where did you learn market profile? I took a course from James Dalton. There's a lot of great presenters. There's a lot of great presentations on, thank you, Sandra, on market profile. I don't know. I just, you learn it slowly as you go. The CME group has some good videos. Talk highly enough about Dan. He's a really good technician. He's very good at explaining complicated details. So that's, I would start at the CME group, go to their education section, type in market profile, and you get a list of videos and information, PowerPoints that you can go through. But there's a ton of good stuff out there on it. And feel free to give me a call too. Be happy to talk to you about it. Let me just put I'm going to use my homemade notepad here to fill in my last couple of seconds. What's my phone number? 322-8559 or direct 6220 trade at infinityfutures.com and Skype. What am I Skype? inf.jim.cagnina. That's Skype. Not always on Skype, but when I am, I drink Dos Equis. Just kidding. All right. Morgan, again, thanks. I think we got all the questions asked. I think I answered. Hopefully I didn't miss anything. Appreciate the opportunity to be able to be the warm-up band for Greg. I'm looking forward to listening to Greg. Thanks, Gun. Appreciate that. The most interesting man in futures. All right, so I think we're going to get a 2-minute break here, and then Morgan's going to come in and introduce Greg. I'm not sure exactly how to stop this thing, but thank you for spending this time with me. I appreciate that. Anything I can do to help, just go ahead and give me a buzz.